Conducting a financial audit for your own business is a critical step in understanding the health and sustainability of your operations. Many entrepreneurs overlook this process, assuming audits are only for large corporations or for tax purposes. However, auditing your own finances provides clarity, identifies inefficiencies, and prepares your business for strategic growth. The first step is to define the purpose of your audit. Determine whether you are performing a full financial review or focusing on specific areas such as cash flow, revenue streams, or expense management. Having a clear goal allows you to structure the audit effectively and prioritize critical sections of your business operations. Next, gather all relevant financial records. This includes bank statements, invoices, receipts, payroll documents, tax returns, and any contracts or agreements that have financial implications. Organize these documents chronologically and categorize them by type, which simplifies cross-referencing during the audit. For businesses that use accounting software, exporting reports for specific periods can save time and ensure accuracy. This preparation sets the foundation for a detailed and thorough review. Once your records are in order, the focus should shift to verifying the accuracy of your financial data. Begin by reconciling bank statements with your accounting records. Check for discrepancies such as unrecorded transactions, duplicate entries, or bank fees that were not accounted for. Reconciliation ensures that your reported cash balances reflect the true status of your accounts, reducing the risk of errors that could affect decision-making. Accurate records are crucial because even small mistakes can compound over time, leading to significant misinterpretations of financial health. After reconciling accounts, analyze your revenue streams. Break down income by product, service, or client segment to identify which areas are most profitable. Assess trends over time to understand seasonality or shifts in customer behavior. Comparing projected revenue against actual figures highlights inconsistencies and opportunities for optimization. For businesses with multiple sales channels, evaluate each channel individually to determine efficiency and cost-effectiveness. This step allows you to allocate resources more strategically and prioritize high-performing segments. Expense management is equally important. Review all operational costs, including fixed expenses such as rent and salaries, and variable costs like marketing or production materials. Categorize expenses to identify patterns and potential areas for cost reduction without compromising quality. Regularly auditing expenses helps detect unnecessary spending, overpayments, or unrecorded liabilities. Evaluate vendor contracts for competitiveness and consider renegotiating terms to improve margins. Efficient expense control strengthens your business's financial position and ensures sustainability in the long term. Inventory and asset assessment is another critical component of a financial audit. For businesses that hold physical inventory, conduct a thorough count to reconcile with recorded levels. Identify obsolete or slow-moving items and consider strategies for liquidation or repurposing. Evaluate fixed assets such as equipment, property, and vehicles to ensure accurate depreciation records are maintained. Understanding the value and condition of assets provides insight into capital allocation and future investment needs. Proper asset management protects your business from unexpected financial strain. Accounts receivable and payable require close attention. Review outstanding invoices and assess the collection process. Identify overdue accounts and implement strategies to improve timely payments. For accounts payable, ensure that obligations to suppliers and creditors are being met punctually. Proper management of receivables and payables maintains healthy cash flow and strengthens business relationships. An effective system reduces financial risk and improves liquidity, which is vital for operational stability. Once data verification is complete, consider conducting ratio analysis to evaluate financial performance. Key ratios, such as liquidity ratios, profitability ratios, and efficiency ratios, provide quantifiable insights into how well your business is operating. Compare ratios against industry benchmarks to assess competitiveness and identify areas needing improvement. These metrics allow business owners to make informed decisions, whether it involves expansion, investment, or cost-cutting measures. Financial ratios are powerful tools for tracking performance over time and ensuring business goals are being met. Internal controls should also be assessed during the audit. Evaluate processes related to cash handling, inventory management, and financial reporting. Determine whether checks and balances exist to prevent fraud, errors, or misuse of resources. Implementing or improving internal controls safeguards assets and enhances reliability in financial reporting. Even in small businesses, establishing clear procedures and accountability can prevent significant losses and promote operational efficiency. Strong internal controls contribute to transparency and credibility, which are essential for growth and external partnerships. Tax compliance is another essential consideration in a financial audit. Ensure that all tax filings are up to date and that deductions and credits are accurately recorded. Missteps in tax reporting can lead to penalties or legal complications, affecting business credibility and financial stability. Reviewing your tax strategy periodically as part of the audit helps identify opportunities for optimization while remaining fully compliant with regulations. A proactive approach to tax compliance reduces risk and contributes to better financial planning. Finally, document findings and create actionable recommendations. Summarize discrepancies, trends, and areas for improvement identified during the audit. Develop a plan to address gaps, whether through process improvements, cost adjustments, or investment strategies. Setting measurable goals and timelines ensures that the audit translates into meaningful changes for your business. Documenting results also provides a reference for future audits and enhances decision-making for long-term financial health. By completing a thorough financial audit, business owners gain a clear understanding of their company's financial position. This process uncovers inefficiencies, verifies accuracy, and highlights opportunities for growth. Regular audits strengthen operational integrity, enhance decision-making, and prepare your business for sustainable success. Taking a proactive approach to financial management ensures that resources are used effectively and risks are minimized, which is fundamental for building a resilient and profitable enterprise. After completing initial reconciliation, revenue assessment, expense management, asset review, and internal control evaluation, the next step is to examine more advanced components such as cash flow forecasting, risk management, budgeting, and strategic planning. These elements ensure that your business not only understands its current financial position, but is also prepared for future challenges and opportunities. Cash flow is the lifeblood of any business. Once your accounts receivable and payable are organized, develop a cash flow statement that projects income and expenses over upcoming months. This involves assessing expected revenue, identifying recurring expenses, and accounting for potential irregular costs such as equipment, maintenance, or seasonal marketing campaigns. Cash flow forecasting allows you to anticipate periods of shortage or surplus, helping to avoid operational disruptions. For businesses with fluctuating income, maintaining a buffer or emergency fund is crucial to sustain operations during low revenue periods. Alongside cash flow, evaluating financial risk is critical. Identify internal and external factors that could impact your business, such as market volatility, economic downturns, changes in consumer behavior, or regulatory shifts. Assess the likelihood and potential impact of these risks and develop contingency strategies to mitigate them. For example, diversifying revenue streams reduces dependency on a single client or product line. Maintaining insurance coverage, securing lines of credit, and establishing emergency reserves are practical measures to minimize exposure to financial uncertainty. Proactive risk management increases resilience and supports long-term stability. Budgeting is a powerful tool for controlling expenses and aligning spending with strategic priorities. Create detailed monthly and annual budgets that reflect historical performance and future goals, include projected revenue, fixed and variable expenses, capital expenditures, and planned investments. Compare actual performance against your budget regularly to identify deviations, understand causes, and make necessary adjustments. This ongoing monitoring ensures resources are allocated effectively and that your business remains aligned with its objectives. A well-structured budget also supports decision-making for growth initiatives and operational improvements. Another key area is analyzing profitability at a granular level. Beyond overall revenue, examine profit margins for each product, service, or client segment. Determine which offerings generate the highest returns and which may be underperforming. Conduct cost-benefit analyses to assess whether certain products or services justify continued investment. This evaluation allows you to focus on high-margin opportunities, reduce low-performing areas, and optimize overall profitability. A clear understanding of profitability informs strategic decisions and resource allocation. Financial audits should also examine debt and capital structure. Review outstanding loans, credit lines, and other liabilities, including interest rates and repayment schedules. Assess whether current debt levels are sustainable relative to cash flow and revenue. Consider options for refinancing, consolidating, or renegotiating terms to reduce costs and improve flexibility. Understanding your capital structure enables smarter financing decisions, whether for expansion, equipment purchases, or operational needs. Maintaining a balanced debt-to-equity ratio strengthens financial stability and investor confidence. Inventory management is another area requiring detailed attention. For businesses with significant stock, conducting a full inventory review ensures accurate reporting and efficient operations. Implement inventory tracking systems to monitor stock levels, turnover rates, and demand patterns. Identify slow-moving items and develop strategies for clearance or repurposing to avoid tying up capital unnecessarily. Proper inventory control minimizes storage costs, reduces waste, and ensures that your business can respond effectively to customer demand. Technology such as automated tracking and analytics can significantly enhance efficiency. Tax planning should not be overlooked in an internal audit. Beyond ensuring compliance, strategic planning can optimize tax obligations without compromising regulations. Review all deductions, credits, and allowable expenses to ensure that your business takes advantage of legitimate opportunities. Consider timing of income recognition and expense payments to optimize tax impact across fiscal periods. A proactive approach to tax management minimizes liabilities, enhances cash flow, and contributes to financial clarity. Regular consultation with a qualified tax professional ensures that strategies remain compliant and effective. Technology and automation can significantly improve the efficiency of financial audits and ongoing management. Accounting software, expense trackers, and reporting tools streamline data entry, reconciliation, and analysis. Implementing cloud-based systems allows real-time access to financial data, facilitates collaboration with accountants or advisors, and reduces errors. Automation of recurring tasks such as invoicing, payroll, and reporting saves time and enhances accuracy. Leveraging technology ensures that financial oversight is continuous rather than periodic, increasing responsiveness to emerging trends and issues. A critical step after analysis is scenario planning. This involves simulating various business conditions to understand potential outcomes. For instance, project revenue and expenses under different growth rates, market conditions, or operational changes. Scenario planning enables decision-makers to visualize consequences, prepare contingency strategies, and make informed choices. It also highlights vulnerabilities and areas that require attention. Ensuring that the business remains agile and responsive, combining scenario planning with ratio analysis, cash flow forecasting, and budget monitoring provides a comprehensive understanding of financial health. Monitoring key performance indicators (KPIs) enhances insight from the audit. Track metrics such as gross profit margin, net profit margin, return on investment, operating cash flow, and customer acquisition costs. Establish targets and monitor trends over time to evaluate progress towards strategic objectives. KPIs allow you to measure efficiency, identify bottlenecks, and evaluate success in implementing changes derived from the audit. Using KPIs as part of a continuous improvement cycle transforms data into actionable intelligence, promoting long-term financial performance. Employee involvement and accountability can strengthen the audit process. Ensure that staff handling finances are trained in proper procedures, understand internal controls, and are aware of their role in maintaining accuracy and transparency. Encourage a culture of accountability where discrepancies or inefficiencies are reported and addressed. A knowledgeable and engaged team reduces errors, improves compliance, and supports effective financial management. Strong internal communication regarding financial expectations enhances overall organizational performance. Once all components have been analyzed, develop a formal audit report. Document findings, including reconciled statements, identified inefficiencies, risks, and suggested improvements. Include clear recommendations with actionable steps and measurable outcomes. For example, propose timelines for addressing overdue receivables, optimizing expenses, or investing in technology. A structured report not only guides immediate corrective action, but also serves as a reference for future audits, tracking progress over time. Proper documentation supports transparency, accountability, and strategic planning. Periodic audits are essential for maintaining financial health. Establish a schedule for recurring reviews, whether quarterly, semi-annually, or annually, depending on business size and complexity. Regular audits prevent issues from compounding, allow early detection of errors, and provide timely insight for strategic decision-making. Businesses that adopt a culture of continuous financial review maintain a competitive edge, reduce risk, and strengthen operational integrity. Long-term consistency ensures that financial records remain accurate and business objectives stay aligned with performance. Finally, leverage audit insights for strategic growth. Use the information to identify opportunities for expansion, investment, or operational efficiency. For example, reallocating resources to high-performing products, adjusting pricing strategies based on profitability analysis, or investing in marketing channels with strong ROI. Continuous learning from past performance enables informed decision-making and positions the business for sustainable success. Combining audit findings with strategic foresight ensures that financial management evolves in alignment with market conditions, customer behavior, and business objectives. By conducting a comprehensive audit, analyzing financial statements, monitoring key metrics, and implementing actionable improvements, business owners gain control over their finances and strengthen decision-making. This holistic approach ensures clarity, reduces risk, and promotes sustainable growth. Entrepreneurs can confidently plan for future investments, operational improvements, and strategic initiatives while maintaining financial stability. A thorough audit empowers businesses to optimize performance, capitalize on opportunities, and achieve long-term resilience. Maintaining discipline in financial review reinforces accountability across all levels of the organization. Transparency in reporting, adherence to internal controls, and proactive management of risks and opportunities cultivate a culture of financial responsibility. Employees, stakeholders, and partners benefit from clear insights, promoting trust and reliability in business operations. Well-documented audits and continuous improvement cycles also enhance credibility when seeking external financing or partnerships. Incorporating these practices into regular business management creates a structured, data-driven approach. Business owners are better equipped to navigate challenges, allocate resources efficiently, and capitalize on profitable opportunities. The financial audit transforms raw data into actionable insights, facilitating better-informed decisions, whether optimizing cash flow, reducing unnecessary expenses, or planning for strategic expansion. The audit process strengthens the foundation for long-term success. Regular review, adaptation, and implementation of findings from audits ensure that financial health is continuously monitored and improved. This ongoing commitment fosters stability, encourages strategic thinking, and prepares the business for future growth. Businesses that prioritize financial literacy and proactive audit practices achieve sustainable performance, maintain competitive advantage, and build a solid foundation for the years ahead.